This week, Theranos founder Elizabeth Holmes was charged with defrauding investors. Holmes now faces at least 20 years in prison. The way she established and sold her startup story offers valuable lessons to investors across the globe now, even to Rupert Murdoch, one of the investors who believed in her idea. Startups can command hefty valuations very quickly, as venture capital and private equity firms in the US's Silicon Valley place a premium on ideas that promise disruptive innovation. New age tech companies can raise millions of dollars in funds even before coming up with a product market fit, or in some cases, even a workable prototype. However, in this glitzy world of innovations and disruptions that are waiting to happen, some founders, like Holmes, are spinning a web of lies and charting their path to success by leveraging the greed of investors. They exemplify the fake it till you make it philosophy. Theranos was founded by Holmes, a Stanford chemical engineering dropout, when she was 19 years old. It was once valued at over $9 billion. And how did she pull it off? Holmes claimed to have developed tests that could help in early detection of ailments ranging from high cholesterol and high blood sugar to liver dysfunction and cancer from just a couple of drops of blood drawn from a finger prick at any pharmacy. The small amount of blood was collected in a nanotainer tube and analyzed in a Theranos lab on a proprietary analysis machine called Edison. The invention was believed to have the potential to revolutionize healthcare and slash diagnostic costs. That was until it came to light that Theranos' Edison machines weren't providing accurate results. The company knew this. So it was diluting blood samples and subjecting them to traditional tests instead of using its famed Edison machines. Soon, issues arose with the US Food and Drug Administration. And as more information emerged about Holmes' deceitful pitch to investors, many of them terminated their partnership with the company. In 2014, Holmes was at the top of Forbes' list of America's richest self-made women, with a net worth of $4.5 billion, with her company valued at $9 billion. 2 years later, Forbes lowered its estimate of Holmes' net worth to nothing. In 2018, the US markets watchdog, Securities and Exchange Commission, charged Theranos, Holmes, and the company's former president, Ramesh Sunny Balwani, with raising more than $700 million from investors through an elaborate, years-long fraud in which they exaggerated or made false statements about the company's technology, business, and financial performance. At its core, the Theranos tale is about a bevy of high-profile investors, from media mogul Murdoch to venture capitalist Tim Draper, not carrying out the adequate due diligence but being seduced by what they must have believed to be a disruptive innovation. Coming closer to home, the Indian startup ecosystem, now the third largest in the world after the US and China, is also maturing at a rapid pace. Some of these upstarts even have a base in Silicon Valley. Last year, 42 Indian startups entered the Unicorn Club. Thrasio-style Mensa brands achieved the unicorn status in just 6 months of starting up. Indian startups raised over $42 billion across 1,583 funding deals. This was more than 3 times the total funding of $13 billion raised in 2020. In fact, the total startup amount for 2021 was more than the total funding of $37 billion for the last 3 years combined. But in this rush of capital, are our venture capital and private equity investors carrying out their due diligence into the health of these new age companies? There's reason to be a little suspicious on this front. Consider cybersecurity. Over the last 2 years, several Indian companies from Big Basket, Dunzo, Haldirams, Domino's, Airtel and JustPay, among others, faced cyber attacks, which compromised the data of their users. Cybersecurity experts have claimed that in their pursuit for rapid growth, startups often ignore the importance of building a robust cybersecurity posture. So, shouldn't investors include checking the cyber health of a company in their due diligence? Let's take another example. Indian edtech startups raised over $4 billion in the last 2 years, compared to $500 million in 2019. The bigger players are acquiring smaller startups to build edtech super apps of sorts. However, a recent government advisory cautioned the public against trusting the success stories advertised by these online educational companies. While startups obviously need to be ethical in their practices and avoid the temptations of the fake it till you make it model, investors, for their part, also need to do their due diligence. To get a better understanding of how private equity and venture capital firms can ensure that their money is safe and learn the right lessons from the Theranos episode, we spoke to Parth Gandhi, founder and chief investment officer at Bombay Capital.
I'll break this down into a few parts. I'll break it down into first pre-investment and post-investment, because it's two phases of when you can actually look at things and get involved in different formats. Pre-investment, the diligence needs to be extensive. One typically private equity funds will hire advisors to help them look at and evaluate financials, legal, accounting. But I think there's another key element that private equity funds will spend time on, which is doing diligence themselves. The team will typically spend and should spend a significant amount of time looking at A, the model, B, looking at, in a startup's case, spending time looking at what the business model is. In the case of Theranos, I'm sure people did spend time looking at the tests, but possibly spend some more time looking at what is working, what is not. Sometimes with startups, you do tend to have situations where funds have to essentially look at and project what the future will be. And of course, in that case, you look at the models, do the investment, then of course, post-investment, we will spend time as a board member being active. One wants to look and visit facilities. I'm sure that is a key element of what a lot of funds do, and of course, funds should be doing. You go out and visit the different facilities, look at the model of the company, see what works, what does not work. And look, it's about being an active board. That, I think, are the 2 or 3 key factors I would look at.
Clearly, it is not easy to spot the unsafe firm or the one involved in fraud. But as Mad Eye Moody's favorite saying goes, constant vigilance is the axiom investors should follow.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.